In this section, we're going to talk about how to measure and record depreciation on plant assets. Depreciation is defined as the allocation of the asset's cost to expense over its useful life. This supports our matching principle. The reason for depreciation are because assets have physical wear and tear, and because some assets get obsolete. Remember, in accounting, land is never depreciated. We assume that land has unlimited useful life. A lot of students think that depreciation is a valuation process where we value our assets, or it's a fund to replace the assets when we have to buy them again a few years down the road. Depreciation is not either of them. It's simply the allocation of the asset's cost to expense over its useful life. To calculate the depreciation expense, you need three items. First, it's the cost of the asset, that is the historical cost of your asset. The second thing is useful life. This is an estimate. You have to estimate what the useful life of the asset would be. The third thing you need is the residual value. This is what the asset will be worth after its useful life. Residual value is also an estimate. So managers need to come up with the useful life and residual value in order to figure out what the depreciation expense is for every asset. In your exam questions or quiz questions, it's easy. They would always provide that for you. There are three methods for calculating depreciation expense: the straight line method, the units of production method, and double declining balance method. GAPS lets us use any of the three methods, so a company will pick the method that best suits them. Most companies will pick the straight line method because it is the easiest method of the three. To calculate the depreciation expense using straight line method, we take our cost, we subtract our residual value, and then what you get, you divide that by useful life in years. Again, the depreciation expense is calculated by cost minus residual value divided by useful life. When you're using the straight line method, once you calculate your annual depreciation expense, this is the same amount that you will use every year over the asset's useful life. You only do this calculation one time. Let's take a look at an example. On 1st of January 2012, Medina Inc. purchased equipment for $18,000. The equipment has an estimated useful life of 5 years and a residual value of $1,000. What is the annual depreciation expense using the straight line method? Remember, to calculate depreciation expense, you need three things. You need the cost, which they've given you to be $18,000. You need residual value, which they have told you is $1,000. And then you need to know how much is the estimated useful life. Again, they've told you that the estimated useful life is 5 years. Now you simply take your formula and plug in the numbers. Depreciation expense is equal to cost, which is $18,000, minus residual value, which is $1,000, divided by estimated useful life, which is 5 years. Remember, the estimated useful life has to be in years. This gives you an annual depreciation expense of $3,400 per year. Now that you know the depreciation expense, you can go ahead and journalize and post it. The two accounts that are always involved with depreciation is depreciation expense and accumulated depreciation. What you're going to do is you are going to debit depreciation expense for $3,400 and credit accumulated depreciation for $3,400. This is always going to be the entry for your depreciation expense. It doesn't matter which method you use, you're always going to debit depreciation expense and credit accumulated depreciation. Now let's take a look at your accumulated depreciation account. It is a permanent account, and therefore it has a beginning balance and an ending balance. Accumulated depreciation is a contra asset account. It is a companion account to your asset. In this case, we bought the equipment, so this is a companion account to your equipment account. But it is a contra asset account, which means it has a normal credit balance. Also, your contra asset account will be shown on your balance sheet along with your equipment. Your depreciation expense goes in your income statement. One more thing, cost, which is 18,000 minus accumulated depreciation, which is 3,400. The difference is called net book value and will be what's shown on the balance sheet. So for this particular problem, you will have 14,600 in your balance sheet, and that will be called net book value. As time goes by, accumulated depreciation account increases. So the balance on the accumulated depreciation account increases and the book value decreases until the asset's final book value is equal to our residual value. The asset's final book value will be equal to the residual value at the end of our estimated useful life. This will be the same for all methods of depreciation. So whether you use straight line, units of production, or double declining balance, your accumulated depreciation will increase over time, your book value will decrease over time until your asset's final book value is your residual value.